Get started. Thanks everyone for coming. Thanks to everyone here in person, everyone watching online as well. My name is Jason Bordoff, professor at Columbia School of International Public Affairs and director of the Center on Global Energy Policy there. And really delighted that so many of you are here with us today in Manhattan, here in Midtown, to hear about the outlook, medium-term outlook for the global natural gas markets. And what we're going to do is first hear from Costanza Jacazio, who is in the gas division at the International Energy Agency. She joined the IEA in November 2014. Prior to that was head of macro and fuel analysis at Fortum, a large utility in the Nordics, a senior energy strategist in Barclays Capital Commodities Research Team before that, between 2006 and 2011, along with many other roles as one of the premier and leading gas analysts. Certainly this is a pretty interesting time to understand what's happening in the global gas market, given a host of changes that are taking place, not least of which has been the collapse in the price of oil and what impact that has on gas production, on gas pricing, on gas trade, among many other things happening in terms of European policy and the outlook for mega projects offshore in places like Africa, the outlook for pricing of gas in the Asian market and elsewhere. So I think we're going to talk about many of those things and much more. We're going to hear from Costanza, who's going to present the summary of the medium-term market report released recently by the IEA, and then I'll introduce the remainder of the panel after that. That'll offer some reactions to it, and then we'll have a conversation and open it up to questions from the audience, both here in person and those watching online. So with that, Costanza, please let me turn it over to you. Thank you.
Thank you very much to Professor Bordoff to have me here, and to you to come here and giving me the opportunity to share with you some of the IEA results. Just let's get started. So on the demand side, we do expect global gas demand to grow at a rate of 2% per annum on average between 2015 and 2020. This will be a substantial rebound, I would say, from the very weak levels of 2013 and 2014. Data for 2014 are still coming in, but we are estimating demand of 0.5%. This 2% will still be substantially below the 2.4% average, however, that was averaged over the prior 10 years. It is also a substantial revision from what we were forecasting last year, of around 140 BCM by 2020. In terms of growth, most of the growth is expected to come still from China, the Middle East, you see the Americas, although both China and Middle East have seen quite substantial revision compared to last year. China, and in terms of regional background, regional breakup, China and non-OECD Asia are the regions of the world where we have made the biggest downwards revision. Roughly 50% of the overall revision come from these to these regions. Also, Middle East and Latin America have seen substantial downwards revision. Oversimplifying a bit, there are two key factors that drive these revisions. On the one hand, we have observed the demand, particularly from the power sector, and particular for Asia, has been substantially weaker than previous forecast and then consensus forecast, which I think casts doubts over the outlook for tomorrow. And I will go more in details of why that is the case. A second key themes which underpin some of the revisions is the lower oil prices, which for energy-dependent economy and hydrocarbon-dependent economies is impacting primary energy consumption and therefore the speed of growth of the sector overall. Is also impacting the speed of infrastructure developments that for gas is quite an important element behind continued growth. On a sectorial point of view, power sector will continue to account for the vast majority of demand growth. Roughly 48% of incremental demand is expected to come from the power sector. clearly this highlight how important the performance of the power sector will be in driving the overall demand growth rate of global gas demand. And I think arguably the power sector is the sector which bear the biggest uncertainties. And I think we need to differentiate here between the developed economies, so mainly Europe, US, and Japan, and the developing market, Asia in particular. When we look at the OECD's economies, and we think about US, Germany, and Japan, one of the major issues which is negatively impacting the speed of growth of gas demand is the fact that electricity demand itself is not growing. So this chart here shows the income elasticity of electricity demand for the major countries, US, Germany, and Japan, in the period of growth which led to the flattening of electricity demand. So in the US, the latest period of growth for electricity demand was the 2001-2007 period. By 2007, electricity demand in the US has really started to flatten. Similar issue in Germany, similar issue in Japan. And you can see that up to that point, the income elasticity of electricity demand was actually relatively high, which meant that for any unit of GDP growth, you were obtaining a decent level of electricity demand. Now, this chart here shows how the economic performance of US and Germany has been relative to their electricity generation growth. And you can see that even in US and Germany, which are economies which have experienced decent economic growth after the financial crisis, electricity demand has been very flat. In Europe, at the very least, many have argued that the fact that electricity demand was not growing was a consequence of the fact that economic growth was not growing, and that Europe had relatively high energy prices. But that doesn't quite seem to fit the story because Germany did see flat electricity demand growth as well as the US, despite having substantially higher electricity prices. So in a world where electricity demand doesn't grow and renewables keep coming in because are policy driven, then clearly the consequence is that thermal generation growth is actually squeezed. With thermal generation growth squeezed, all the space left for gas demand to grow is a consequence of the shutdown of coal capacity. Good news for gas, coal capacity is indeed shutting down, but clearly this limits the space of growth. In non-OECD economies, in particular in developing Asia, I think the challenges are somewhat different. Electricity demand is growing, but I think what the industry, I think, got wrong, and the IEA probably got wrong as well, has been the assumption that Asia would have taken whatever quantity of gas at whatever price. And that was somewhat the underlying operating assumption of most of the industry and the analyst community. On the back of the idea that so much electrification still need to occur in many of these economies, and on the fact that many of these economies are starting to show an increasing level of environmental consciousness, which should lead to gas demand to increase. The problem is, as this chart here illustrates, that the vast majority of the coal-fired capacity fleet in the world is located in countries which do import LNG. So roughly 75% of world coal-fired generation capacity is located in countries which are dependent on LNG and not on domestic gas, meaning that coal there does compete with LNG and LNG prices. So in a world of LNG prices of sort of $15 per million BTU, the result has been that many of developing Asian countries have actually opted to build coal rather than gas, or to at the very least limit the quantity of gas imported. A good illustration of this is India, for example, which when the upstream in India started to disappoint, was coal imports, the bit or records, weren't really LNG imports. Another example is Malaysia, which is endowed with a very vast gas resources, but it did choose to build a very super efficient coal fleet to export its own gas and actually utilizing for its domestic consumption imported coal. And I think sort of this trend is somewhat underlying the choices of many developing Asian countries, which I think is one of the key reasons behind the disappointment of Asian demand growth over the past couple of years. The other issue is that if you do look from a price perspective, so much new coal generation capacity has been built in the world over the past 5 years. 350 gigawatt of coal went online between 2010 and 2014. Many of these, particularly in Asia, are super efficient coal plants, which means that gas will really have a hard time to compete with these coal plants. For an ultra-critical coal plant, you would need a $4 per million BTU gas price to displace it, or assuming $8 per million BTU gas price, which would be already quite low price from a cost point of view to deliver LNG to Asia, you would need a carbon price of $50 per ton to actually start to displace coal. And I think the critical problem is that if you do have a carbon price or a carbon tax at that level, renewables will start to come in economically before gas gets coal displaced. And so I think this will limit somewhat the amount of growth of gas in the power generation system. The other important theme is about China. And again, I think a couple of years ago, there was an extreme enthusiasm with respect to the potential of gas demand growth in China, partly based on the assumption that China was becoming more serious and more radical in addressing its environmental challenges. And I think this is true that China is becoming more radical in addressing its environmental challenges, but we need to distinguish which challenges it's trying to address. I think on the top priority, it has been the cleaning of the air and addressing local pollution problems rather than necessarily limiting CO2 emissions. And this has very different implications with respect to the policy choices that you might want to go for. So the sector that keeps growing very strongly is the residential sector in China, where policy has been quite supportive of switching away from coal boilers to gas boilers in those sectors and in small industrial applications. These sectors account for a disproportionately high quantity of particulate matters, but for a very small quantity of primary energy. So from an economic environmental benefit standpoint, that does make sense. That, however, doesn't really impact the power sector, which is, I think, where gas demand disappoints the most. And if you do look at the expansion of energy sources with low particulate and and sulfur emissions we do expect, but many of these plants are already currently underway, between 2014 and 2020, the biggest contributor to cleaning up the energy in China has been retrofitting coal plants. There's no real necessary switching away from coal into gas. And so I think that has important implications in the way gas demand is performing in the power generation sector and will perform. And it's partly the consequence of why we have downwardly revised Chinese demand growth. The other key point is the competitiveness of renewables. So renewables are becoming increasingly competitive due to a number of different issues. One is the reduction in the cost of renewable technology. The other is clearly the availability of cheap capital. And there has been some remarkable results in auctions, for example, for PPA contracts in countries such as Dubai, that has seen an auction price of $60 per megawatt hours, which start to be really competitive versus gas as well. So I think this theme of gas being squeezed between renewables and coal, it's real and in a sense will continue going forward. Clearly, gas will have a space. The system cannot really work without gas. Gas will need to provide backup power for the variability and the intermittency of renewables, and we still grow in other sectors other than power, such as industrial, residential. But I think the growth will not be as strong as we were previously forecasting. Now, I talk a lot about the negative aspect of the demand side. There are also positive aspects, and that's why we do expect the rebound in demand growth that I highlighted at the beginning of the presentation. And I think price-sensitive countries will see a rebound in their LNG intakes and in their demand due to this price fall that we have seen over the past year and a half. A case in point, I think, is India. India has a substantial amount of gas-fired capacity, around 25 gigawatt currently. Back in 2010, 2011, when the upstream was still performing and therefore it has access to cheap gas, the load factor of that capacity was around 60%. Now the capacity is running at 20%. India has spare infrastructure capacity for importing gas and has therefore spare already built gas-fired generation capacity. Should India be able to bring the load factor back to 60%, this would give you an additional 15 BCM of imports into India, which in the context of the global LNG market is by no means negligible. And so I do think that India is one of those countries which could see a rebound in imports, also because any rebound in imports, any increase in fire generation utilization would actually go in addressing power shortages rather than getting in direct competition with coal. In countries where this is true, we might indeed see some rebound in gas demand. For limited time, I'm not going to address in detail the transportation sector, but I think this is another interesting topic where demand, we do expect, will continue to grow strongly, at least in the heavy trucks and closed fleet vehicles. This chart here shows the fuel switching impact of 2014 US car sales, vehicle sales. So how much oil was replaced by utilizing alternative vehicles. And you can see for gas at least, by far the vast majority has been still in the truck and closed fleet vehicles. The sales of gas car sales actually fell and declined, while on the other hand, electric vehicles continue to do pretty well, which to me indicate that we might actually have electric vehicle having leapfrog sort of gas cars at the very least in the light-duty passenger vehicle. This is sort of true in other parts of the world as well. So I think there is potential, and we do expect transport to remain a strong growth sector for gas, but clearly in the heavy truck and closed fleet segments. Quickly moving on production, again, we do expect OECD Americans and OECD Asia, mainly US and Australia, to lead the growth of global gas production. We had done a number of downwards revision, mainly again in countries where we do think that lower oil prices will impact investments in the upstream, and also in country, and particularly in China, where we did see substantial disappointments in the development of unconventional gas resources. So currently China has just one major block of shale gas that is under development. Drilling tests have been disappointing. The geology is proving more complex than previously thought. Lower oil prices will further discourage investment in this sector. I think also the lack of third-party access to the transmission infrastructure is discouraging private companies to get into the market and develop their upstream. So, and just a last point to notice perhaps in this chart is OECD Europe performance, which is the only region where we do expect a substantial production decline in the region of 30 BCM, so 3 BCF per day, which is quite substantial. So as a chart before illustrated, most of the additional production is expected to come from North America and Australia, and some of this additional production is actually linked to new LNG projects. There are currently around 165 BCM of additional LNG capacity, which is set to come on stream, 90% of which is set to come on stream from Australia and the US. This capacity will come online irrespective of prices, simply because LNG capacity is really price insensitive in the short term due to the very strong proportion of capital cost in the full cycle cost of projects. In the US also the financial exposure is on the buyer, so these projects that have been FIDs will come on stream by then. At the same time, when we do think about the next generation of projects, what has been clearly remarkable has been the drop in offtake agreements being signed once oil prices have started to decline. So this chart shows the offtake agreements that were signed in mid-2012 to mid-2014 for US-based projects. So you can see there were very many, and there has been not much done since, just a very small contract, which highlight, I think, two things. Number one, the fact the Henry Hub-based pricing has lost ground relative to oil-linked prices, simply because oil prices have fallen so much, so there is more uncertainty on the part of the consumer on which sort of pricing they might want to go for, while through that period pretty much every Japanese utility wanted to have some sort of exposure to Henry Hub. The second thing is demand has performed worse than expected, so there is much less sense of urgency on the buyer side to lock in quickly new contracts. And this illustrates the position of Asian buyers. We show here the contractual position of Japan versus the demand growth that we do expect for Japan gas demand. This demand growth is underpinned by an assumption that a rough 10 gigawatt of nuclear will come back by 2020. I would argue is a relatively conservative assumption compared to what the Japanese government is, for example, projecting, but tells you that even with relatively conservative assumption on the return of nuclear, Japan might well not need to tap into the spot market by 2020. And if you do assume that more nuclear will come back, there is actually the chance in Japan might need to become a net seller on the spot market by 2020. And I think this is one of the key reasons why we are struggling to see new contract being signed, on top clearly of the challenges of a much lower oil price environment, both on the economics of producers and on the challenges of what sort of contract type a buyer would like to go for. I almost finished here. On China, the other thing to note is that Chinese supply will become substantially more diversified than previously was. So this represents Chinese incremental gas supply that will meet the demand that we project. And we expect, you can see that a little bit more than 1/3 will come from pipeline gas, sort of 47 BCM, a little less than 1/3 from domestic production, and the rest from LNG. It's not a remarkably strong number for LNG because demand, it's not growing as impressively as previously thought. But the supply side is becoming more diversified, which I think will potentially give China the possibility to become a stabilizing factor for potential demand and supply imbalances in the region. Till very recently, the only region that had the possibility to really balance out imbalances somewhere else was Europe, due to its switching capacity on the demand side and its switching flexibility between LNG and pipeline gas on the supply side. As the supply sources into China are becoming more diversified, I do think China might indeed play a bigger role in rebalancing potential imbalances in non-OECD Asia in particular. So this just illustrates where we think the additional LNG supplies will flow. You can see a good chunk in China, a substantial chunk in non-OECD Asia. There are a number of new countries which are becoming net LNG importer. Pakistan just started a new terminal. Thailand is expanding its own terminal. Malaysia and Indonesia are also expanding their existing terminals. We expect Vietnam and Bangladesh to have terminals by then. But still, notwithstanding this increase in import capacity in emerging market Asia, the volume coming onto the market is such that I do think Europe will need to absorb a substantial quantity of this LNG. And we expect LNG into Europe to roughly double by 2020. Now, even with this doubling of LNG imports, I don't think Europe will see any meaningful displacement of Russian flows. So this chart here shows the how the incremental demand will be met by alternative supply sources. So in 2014, Europe imported roughly 150 BCM of gas from Russia. You can see how between 2014 and 2020, we are going to have an increase in domestic demand, weather dependent, then an increase in real domestic demand, mostly from Turkey, which is incorporating the balance of OECD Europe, and a little bit in the power generation sector due to capacity shutdown in coal. But then, because of the steep fall in domestic production, even a double of LNG imports and a little bit of Caspian gas flowing to Turkey by 2020 will not really displace Russian gas. So I do think that this LNG will not necessarily be pushed into Europe, will not necessarily feel like a pull either, but will be somewhere in between, just enough to accommodate the demand needs or the incremental import needs that Europe will have. So this, I think, conclude my presentation and the key themes that I wanted to highlight. And I hope we can then have a nice discussion afterwards. Thank you.
Thanks so much. That was great overview, very comprehensive. A lot of issues you put on the table to discuss, and want to get reactions. First, from our fellow panelists, Majed Limam is senior consultant with Poten's Natural Gas and LNG Consulting Department, has 12 years of experience in the gas sector, previously a projects control manager with Zachary Construction Corporation, currently leads Poten's global LNG supply and demand analysis team, and has advised clients around the world on LNG procurement, project development, market due diligence, LNG pricing and market strategies, and most importantly, is a graduate of Columbia Business School. Leslie Palti-Guzman, most importantly, is a non-resident fellow at the Center on Global Energy Policy. Also is currently director of global gas at the Rapidan Group as of just about 6 weeks ago, I think. Leads the coverage at Rapidan of global natural gas markets and LNG and pipeline projects and unconventional gas. And prior to joining Rapidan, was a senior analyst at Eurasia Group in their global energy and natural resources team, and also has served as the senior natural gas and LNG correspondent at Energy Intelligence Group here in New York. So there are many specific issues that came to my mind as I was listening to that. I wanted to ask a couple of questions and then open it up to the audience as well. I'll remind those of you watching online, you can follow us on Twitter at Columbia U Energy, and if you have questions, pose them via Twitter with the hashtag CGEP events, Center Global Energy Policy, CGEP events. But first, let me just sort of open it up a little more broadly, Leslie, and ask you to sort of maybe pick the one or two things from that that were most striking to you, that you think are most noteworthy, that you agree with most strongly or disagree with most strongly, and sort of see what issues you'd like to put on the table. And then the same for you, Majed, and then we'll come back to some other particular topics that I just wanted to pose before we open it up.
Yeah. So I think, the report points rightly that we are at the crossroad in the global gas market. And there is a lot of optimism in the US, but when you go out from the US, which is becoming now this global energy superpower, in the rest of the world, there is a strong disconnect in the role that gas is going to play, and a lot of pessimism in Europe, and a lot of uncertainties in Asia. A lot of surprises can happen. A lot of unknown are still out there, and it's right now it's up in the air. Like I'm thinking about, the negotiation in December in Paris and whether there will be a price on carbon. A lot of oil and gas company, actually 6 major oil and gas company in June have asked for this carbon price to happen because they see it as the only way for gas to play its role as a transition fuel. There is a competition between coal and gas in Asia also, and the price issue is here like one of the most important elements. And the new pricing of gas right now, like we're in the new gas order. If you compare 2015 versus 2014, there is a drop of the oil prices that has impacted long-term gas contract. Huge drop in the spot price of gas because of this abundance of gas and new supply coming from Australia, but also this new wave of supply from the US that will start at the end of the year. And on the trade side, I think the most important dimension is like the increased flexibility in the global LNG trade. And this is changing the attractiveness of LNG for many new buyers. Like just now in 2015, Poland, Lithuania, Pakistan, Jordan, Egypt are starting to import LNG. And so cumulatively, those are very small markets, but taken together, they are starting to be an interesting market. So, all in all, there are negative dimensions, positive one. I think from what you mentioned, the disappointing growth in Asia, surprised the market. And a lot will depend on the nuclear restart in Japan. And I think, as you mentioned, the Japanese government is overly optimistic about their plan. And we may see, a long-lasting need for LNG in Japan. It doesn't mean that it will grow much beyond what they are importing now, but it will remain stable for the years to come. And China, obviously, is the big question mark, and whether the pipeline with Russia will materialize on time, and what will be those volumes, and what will be displaced, on the LNG side. But I think LNG will be needed in the long term and in China, and has a huge role to play, and in Asia and Southeast Asia also is a growing niche market.
And just to follow up on that, so, because you showed those charts about how gas actually lags far behind renewables and retrofitted coal, and how China is actually going to meet power needs and address pollution concerns. You showed data about how it's not just potential for weaker economic growth in China than people think, but structural changes in the energy intensity of the economy.
Sure.
So, does that lead you, first Leslie and then Costanza, to be more skeptical of actually how much gas demand and LNG demand there's going to be in the Chinese market?
Power generation is one, electricity is one. I think transportation, is something that we underestimate widely, like in the global gas market. And China now is like the country that is going to use the most gas in a natural gas vehicle, for instance. I think the diversification of the supply portfolio in China means that there is an above all strategy from the government. They don't want to put all their eggs in one source and one kind of fuel. So pipeline, unconventional, LNG have all the role to play. That's my view.
Do you have any comment on that?
Yes, I do think that, I do think that this energy transition the Chinese undertaking is having clearly huge consequence in terms of primary energy growth. Coal demand fell last year, has remained weak this year. China is having one of the most energy intensive economy in the world. The cement sector accounts for something like 10% plus of Chinese economy. So clearly at that transition happening, as China move away from this just a basic infrastructure sort of economy to a more sort of upgraded, value-added economy, and where its consumer society develops, that will have repercussions through all the primary energy components of the energy mix, including gas. Now, that said, I think gas is far less sensitive to these changes than coal actually is. And therefore, whatever are going to be the environmental policy actions that China will decide to undertake, those actions will be the most important element in driving Chinese gas demand growth. While I do think that coal has a much stronger sensitivity to the change in the economic structure. Still, as I mentioned in my chart, the message I wanted to give you that I do think the first step of the environmental undertaking that China has gone through has been about cleaning the air rather than curbing CO2 emissions.
Which people often equate as one leading to the other, and your point is that's not necessarily true.
Not necessarily true. My point though is does China then become much more committed to further reduce the CO2 targets that it has, then at that stage we might need to see further policy push for gas in power, but it's not necessarily a given.
Yeah, I want to come back to that, and particularly the recent announcements that China has made about its climate ambition and what that might mean for gas demand. But Majed, let me just get your sort of general reactions first to what we were just talking about, but more broadly, the presentation as a whole.
Well, more broadly, perhaps to start, we do agree. The development of demand on the natural gas end, and of course then LNG is critical to the growth of LNG markets. We're in a world now where there are many supply projects competing to take FID and develop, targeting, in our view, a available demand, quality demand, mostly in Asia, that can anchor these projects, but that is finite. So the key bottleneck to developing more LNG supply project is development of quality demand from buyers that can structure, anchor, make projects bankable. So this links in a way to that struggle with developing quality demand worldwide. But we do see opportunities, but not for all projects, but for the projects that are able to match with key buyers and quality buyers. So we see buyers on the LNG world in a way as kingmakers to the whole chain, fitting in with the view that quality demand may be hard to get to in the next 5-6 years. Having said that, China and India, when we do at Poten sensitivity analysis on LNG demand, China and India are the markets that, in our base case, would experience most growth. I think in 2014 together they imported around 34 million tons per year. We see that growing to around 90 million tons per year by early next decade. So obviously that's a key market for LNG. But there are issues, and yes, there's competition from other sources of fuel. LNG is not going to compete against coal, will not be able to on cost, on price. It is an environmental decision, perhaps targeted to certain areas of China and India that will allow LNG growth, but economically very difficult to compete against coal generation in both countries. The key is for LNG and natural gas is potential downstream price adjustments in both countries that will make LNG competitive and allow the chain to sustainably work as a LNG imports into China and India. Because if you see today, you look at LNG prices worldwide on long-term contracts, even after oil dropped, large subsidies are needed for LNG to make its market share. So unless both countries make substantial changes, fundamental changes to the downstream market mechanisms to allow gas to be priced in an economic fashion, yes, the LNG demand could be at risk, and this is one key aspect we look at it in detail. Yeah.
And Costanza showed one chart about, the trickle, the slowdown in the number of contracts being signed for, I think that was for U.S.
Yes.
projects, given the collapse in the oil price and less interest in Henry Hub indexation, which was a little surprising to me because, these are projects that come online in 2018, 2019, and this is for supply post-2020 mostly. So making those sorts of decisions, because we have seen in the last 6 months a price collapse, is there some disconnect there? And do you think that as a result of the current oil price collapse that the medium to longer term outlook for U.S. LNG exports is significantly changed?
Actually, yeah, that is a very interesting graph. I like it. It does show that there's slowdown on FIDs eventually, final investment decision, on LNG projects. So that's worldwide is a trend. Outside the US, this is driven by, of course, lower oil prices making the economics of the LNG liquefaction projects more challenging. At $100 oil, you have a lot of projects, LNG projects, most projects worldwide economic, not all, but most. At $60 oil, that's a tough market to have the economics of LNG at a project level work. On the US, of course, that's Henry Hub driven type approach on pricing, on feed gas procurement, and many back-to-back then from there on Henry Hub. But we do see slowdown, and that probably has to do with the Asian buyer attitude towards how much exposure more do we need with Henry Hub. Let's wait and see approach, because we have so many options worldwide. We have East Africa, we have US, we have Canada, we have additional potential Australian expansion projects. And we're not sure about demand, as we've talked about. So wait and see approach on this buyer's end is also contributed to less FID activities.
Yeah.
Yeah. Well, if we take an analogy, for instance, and you're an investor and you have different currency in your portfolio, you want some euros, but you want some dollars, you want some yen. So LNG buyers are the same right now. They want to diversify their pricing exposure. So they want to go away from oil indexation. And for Japanese buyers, for instance, they have an appetite for about 20% of their portfolio on Henry Hub linked gas pricing. But beyond that, they may be reluctant to put too much Henry Hub also in their portfolio. So, both buyers and sellers now see an advantage of having diversifying pricing, but they don't want to put all their eggs in the same basket. So I think Henry Hub, you need to take a long-term perspective for Henry Hub linked LNG. And, we're in a world where oil prices are becoming very volatile. So they will go up again, and Henry Hub linked LNG may regain competitiveness versus oil linked gas and so on. So it's a long-term strategy for buyers and sellers want also to respond to the request from the buyers of having this different pricing exposure. So they want also in their portfolio Henry Hub linked LNG.
So the takeaway from that is your outlook for U.S. LNG exports today is not much different than it was a year ago, or is it significantly different?
So I think, the projects that are the best positioned in the U.S. remain the brownfield one, and there are, at least 2 left that could take FID in the next 2 years. Beyond that, it's more complicated, but it's just a global, circumstances where you have lower gas demand, cyclical downturn of gas demand in Asia, lower oil and gas pricing. So only the projects that have strategic location, very large resources, and the timing is going to be crucial. So companies need to mitigate their cost and have like a very low break even. If all that works, those projects will go ahead. But instead of thinking about 3 trains, projects are going to be more modest, and they may start with an offshore facility and then combining with onshore, like in Mozambique. It's becoming more down to earth.
We'll open it up to questions in just a few minutes. I want to cover a few more topics. But is that true? So is that true for IEA? Their view of U.S. exports is pretty much not changed as a result of the...
I would argue the USS, but I agree, are the best place to actually go on. Now, the question is, if your demand doesn't grow as you were expecting, there is less demand and there's less urgency. So that will slow down the process compared to what the process would have been and the quantity of new LNG would have come on stream if actually China would have grown at 14% rather than 9%, if India was growing, etc., etc. So, I think the US are well placed. I think we will see more LNG from the US in the 20s. But clearly, as both panelists have highlighted, there are more challenges and the process will be slower.
Let me walk through a couple of specific locations or regions in the world to get your reactions to the outlook there, and then we'll open it up. We'll spend about the last half hour with audience questions. Europe. The European Energy Union proposed recently the white paper that the EU put out, the efforts that Russia has undertaken recently to try to find alternative pipeline routes into the European market. Costanza, can you talk a little bit about what the outlook is for gas, given the kind of energy policies Europe has put in place? How much room is there for gas in those policies? And then talk a little bit about the role of LNG supply into Europe and the role of Russian gas into Europe and what the outlook is going to be.
Yes. So as I showed in my last slide, basically we don't expect by 2020 the dependency on Russian gas to diminish in any meaningful way. The biggest reason for this, as I mentioned, is declining in production. Now, when it comes to how the EU policy plays into this outlook, I think the reality of the matter is that in the short run, probably the biggest change I see coming is a more forceful push for true integration of the European energy market, which has progressed in the past few years but has by no means been fully realized yet. So as interconnection increase, as the competition of the European market increase, as the potential for reverse flows increase, all bidirectional capacity in all the major transmission lines is actually put in place, this will in itself enhance the security supply of Europe. When it comes to the ability of Europe to diversified supply sources, I do think in the 5-year outlook that I showed, the potential is far more limited. Because if you do think about what else you have rather than Russian gas on a pipeline perspective, you have North African gas, which I think is more a function of what happens in North Africa than what happens in Europe. I don't think necessarily strengthening the strategic partnership between Europe and North Africa is going to get necessarily many more BCM or North African gas into Europe. When it comes to Turkmenistan, when it comes to Kurdistan, when it comes to the Caspian, I think it's a very long-term project. And the other problem that I do see is with respect to financing. So it's clear that you can diversify supply, but ultimately somebody needs to pay for it. And it's much easier to diversify supply in an environment where your demand is growing, simply because okay, those new demand will be met by supply. There is a market. There is a clear sense of private sector participation, which is underpinned by the economics of the project itself. But when it comes to diversifying infrastructure in a stagnant or declining sector of demand, it's much more challenging. So I think it remains to be seen how the Energy Union will go on with that, but I do see some major challenges in bringing new supplies on stream with substantial private sector involvement. When it comes to Russia, then of course much will also depend on the Russian strategy and what Russia does decide to do, and not only on what the European Union decide to do. So in our report, we do assume that one line of this Turkish line that Russia has mentioned will go on, mainly just the first line to Turkey, because I think economically can be afforded, and because of still these sort of spare part and contracts that are a legacy of the build-up of South Stream. So that's probably it's doable. Bringing and scaling it up substantially above that might actually be more challenging. So I think the bottom line is that Ukraine will still be an important transit country for Europe by 2020.
Majed, what's your thoughts on the outlook for LNG supply into Europe? And also, the view in the U.S. had been for some time, well, the price in Asia is just going to draw those supplies into Asia. They're not going into Europe. Does that look different today?
I think, well, one key aspect that links to your question of what Costanza said is how difficult it is to develop infrastructure. So on the supply side, I mean, for LNG projects to develop, say, from scratch targeting Europe, that has to involve take-or-pay agreements, the whole project in place, the whole chain, bankable projects. We have not seen Europe able or maybe needing to do that for the last 8-9 years. Most LNG projects that have taken FID have been targeting Asia. So Europe is in a place now where there's no dedicated supply from an LNG perspective. A lot of diversions happening, a lot of flexibility. But buyers are not able to go in and have long-term commitments just because how the market is evolving, the tension between long-term pricing and hub pricing that puts utilities at risk. So those are issues that, in a way, work against security of supply, to be able to secure supply in the long term. Now, the US projects, some of the capacity is dedicated to end users. Some is dedicated to trading houses or aggregators, portfolio players that are seeking to, in our view, to commit those long term. If they don't for the full amount, that leaves opportunities for Europe to attract LNG, even though they were not anchor type buyers, which is an advantage. Europe has spare capacity in its import terminals. The issue is, does it then have the price to attract LNG when it needs it? So in a position where you're exposed to more short-term spot market, when you really do need it, say a very cold winter, the LNG may not be available to you because somebody else in Asia has got it committed or willing to pay a higher price. So all of these are really big, important issues. LNG can still continue to play a key role, but that aspect of it that is long-term, that is committed to buyers, is really not available to Europe anymore, just because of the structure of the market and more availability on a spot short-term. But that depends just what happens on the global market rather than what Europe actually does need.
And so just to be specific about it, what sort of prices would be needed in Europe versus in Asia to start to see significant supplies get redirected into the European market?
If it is Northwest Europe and the UK, then it's really NBP driven, TTF driven, which is really quite a strong linkage to NBP. So for Europe to attract LNG away from Asia, NBP has to be higher than not just JKM, but even some of the medium-term oil-linked formulas. In our view, in our projections of NBP levels, it would be hard for the US projects to develop fully on a life cycle cost targeting Northwest Europe. But in the cash cost, once they have sunk cost and are operating as a market of last resort, economically it does work to target NBP at the levels we see.
Leslie, looking at the outlook for gas in the Asian market, can you talk a little bit about your view on the outlook for the pricing formula, for the potential for spot market to develop in that region? Are we going to continue to see oil indexation as far as the eye can see? And what does that mean for gas demand? Do you differ at all from what we heard in terms of the IEA's outlook for that?
So what's interesting is that in the current new pricing environment, we could have thought that Asian governments would put less emphasis on the creation and the emergence of mature physical hubs in Asia. But actually, there have been, just in the past 2 months, very active moves from the government in Singapore, from Shanghai Exchange, to actually accelerate the creation of an exchange and giving like LNG, creating an LNG benchmark in Shanghai, in Singapore, and Tokyo has already tried that like for more than a year. It takes time because there is not enough liquidity, not enough trade yet around those areas. And it's a top-down approach, like a very institutionalized approach, like similar to what happened in the European Union market. So it takes time for the market to gain confidence, but I think it's only a matter of time. The signpost to watch is not necessarily how much liquidity and trade we're going to see around those hubs, but how much willingness the market participants want in terms of transparency around gas pricing in Asia. And yes, we have increased flexibility in the market. A lot of US LNG will be resold on the secondary market. We see a lot of swaps that are going to happen, some reloading, but it's not replacing hubs, because what hubs will do and what a price benchmark in Asia will do, similarly to Henry Hub or NBP, is that it will provide transparency around the pricing, and you cannot get that through bilateral relationship between a buyer and a seller. Just calling your counterpart in Asia and say, hey, I have a spot transaction for you, are you interested? And then nobody else know about it, and you can differentiate pricing. So only hubs will bring this kind of transparency in the market.
Costanza, are the higher cost sort of projects in the new gas frontiers like East Africa and Eastern Mediterranean just on hold and in this price environment, we shouldn't be thinking about them? Or is that an overstatement?
Depends on which time frame you're talking about. I think for East Africa, East Africa has a lot of resources close to the final market, but I wouldn't be surprised to see delays in East African projects. I mean, you do not have any basic infrastructure. The regulatory framework is still in its infancy. You have companies which are developing the resources which are not necessarily expert in liquefaction. So I think there, and then of course they do face their capital constraints as all other companies face. So undeniably, it's a very challenging outlook to bring and commit to very expensive projects. Could few million ton of offshore LNG come online in the next 5 years, 6 years? Sure. Could East Africa gas revolution realize on that time frame? I don't believe so. Now, if we take a much longer time frame, I do think East Africa is indeed well posed when prices will recover to actually be part of the supply response to still growing demand in Asia. Then, as you highlighted, as we move in the 20s, somebody will need more LNG. So I would place East Africa with the US as some of the best positioned to take advantage of that demand.
There's been a lot of attention focused on oil supply in Iran, but in the late 2000s they had some pretty ambitious plans to become a gas exporter too. If the sanctions are lifted in the, however, next year at some point, can Iran increase production substantially and become a major exporter in the medium term, do you think? Do we even have is there enough market to absorb that supply?
No, I do think that if Iran does come back, I think Iran is very well poised to perhaps take the space that East Africa might not take. Of course, that is a matter of timeline, because even if companies come back into Iran, let's say by the end of the year, you do need time to develop the infrastructure, to make sure the contract structure is also revised, to make the environment attractive, to sign the contract, and we saw the difficulty the company anyway had at the current price environment to sign the contract. So even if Iran comes back into the picture, it's not going to be in the next 5 years. Now, we talk about a 10-year time frame. When Iran gets in the picture, if something goes wrong in other places, things delayed for whatever reason, then I think Iran is indeed in well positioned from a cost point of view to take advantage of that demand.
You're nodding, you agree with that?
Yeah, I mean, and I'll just add, yeah, Iran has huge reserves. I mean, the one thing we do look at is the domestic requirements for natural gas demand in Iran itself. So there may be limited opportunities for export. And then back to the fact that really demand is driving this globally. So in the LNG sector, the LNG buyers being kingmakers, would they prefer Iran to a project in the US or East Africa? And this is then a question of their diversification of price, as you mentioned, Leslie, but also supply sources. And in our view, yeah, there may be advantages. Iran is a new LNG country, so some level of diversification there. But then you are in a region that is problematic, and then the transits through the Hormuz that a lot of the LNG is subject to makes Iran not necessarily the best diversification from an Asian buyer perspective. And if they are key to the chain working, then we do look at their view on and their interest on that. But we see other areas of the world that could fit that better. Yeah.
What's the IEA's view on shale outside the US?
Again, I take this sort of time frame as the benchmark here. Not very positive, I would argue, by 2020 for sure. There has been positive and negative developments. I think the most negative development has been clearly China. I think there has been a number of disappointments linking to different issues. One is indeed, as I was mentioning during the presentation, the geology of the shale itself. Everybody knew that was more complex than the US one, but then it's proving even more complex than previously thought. It's not just about the depth of the shale, but it's also the it's not as continuous as the US shale is, so it's much more difficult to drill these very long laterals that in the US do allow to extract at very cheap prices these sort of resources. The population density is also another huge problem, with much of the resources, the drilling effort being concentrated in the Sichuan province, which is actually very densely populated. There are other areas of in China besides Sichuan that do have a lot of resources, like the Tarim Basin in the north. But again, also the geology there do seem challenging for different reasons. On top of it, I do think that the lack of actual deregulation in the Chinese market, it's indeed hampering the development of Chinese shale gas. Because shale gas in China is listed as a different commodity to gas itself, which basically means that private participation in the extraction process, in the upstream, is allowed, but you don't then have third-party access to the infrastructure itself, which basically puts you in a sort of difficult position in a system which is dominated by the big players. So I think all these elements are a problem. In Europe, I think it's a matter of, I don't see any area in Europe really becoming a major shale player anytime soon. The two countries, Romania and Poland, which were allowing companies to come and explore, actually have seen many withdrawals over the past 12 months, not just because of clearly lower oil prices have had an impact, but also drilling tests have been disappointing. I think perhaps the emerging potential is really still in Argentina. We did see some positive developments of late in terms of company coming in and at least put one foot into it. No major investment clearly have yet been made, but should the government move forward and enhance this sort of current policy to attract again and to regain confidence from the investor community, I do think there is a lot of hope that indeed the Vaca Muerta could indeed be a very, very good geologically speaking shale. So I see some positive movement there, but far from saying, okay, Argentina is going to be the next gas shale story.
Right. And just to close, can you quickly comment on the point that came up earlier that, we've seen significant announcements on climate made, China, US, Brazil, just yesterday. If we see more aggressive steps being taken on climate, what does that mean for the gas outlook?
Well, I do think gas is much more resilient than other fuels, clearly, to any very strict CO2 reduction goal targets. In the IEA 450 scenarios, which basically imply limiting the temperature increase to 2 degrees, gas is the only fuel that actually show growth versus coal and oil, which needs to peak, and we see actually a contraction. That said, even in that scenario, gas grows less than in a business as usual scenario. And I think the reality that if you do want to achieve that sort of climate target, you basically need to get to the point where you also limit gas consumption. And so you will need more renewable, you will need carbon capture storage, you will need all a series of new technologies, which ultimately will have less of an impact on gas in the fossil fuel space, but we still have an impact on gas.
So that leads to the first question we have via Twitter, and while you're answering that, maybe we could bring the microphones up, and I think there was a question here in the front row, if you still have it. But the question from Twitter was about the future of CCS and whether 2 degrees is even still reasonable. But, you know, CCS people talk about as coal, it has to play a role for gas too in the long term.
Sure. Where it's reasonable? Well, it's reasonable to think that policymakers will agree to a 2-degree carbon reduction. Who knows? I think what would be interesting to see is whether you can forge an agreement which is tight enough that allow investors to believe that 2 degrees is achievable. And so that would probably forge the confidence to go on and invest in new technologies and basically, you know, put money into what is required to develop the technology needed to actually achieve the sort of target. So I see that, you know, we might create a positive, fulfilling process if policymakers come together and do agree on a tight target, if not necessarily a 2-degree target.
Yeah, here. If people could introduce, identify themselves and ask brief questions, please.
Hi. I'm Ernest Kafka, and I'm an amateur in this field. But I want to congratulate you on the complexity of the factors that enter into this situation that you've been able to cover. And I have a question about what I think hasn't been covered, and that is on the demand side. You emphasized the uses in transportation trucks of the hydrocarbons and heating and electricity and generation and so on and so forth. But hydrocarbons have a lot of other uses, and I wonder if some of them might be on the verge of being able to make more use of hydrocarbons. So I have, for instance, written down fertilizer, carbon fiber, piping for transmission of oil or for transmission of electricity or glass fibers, pharmaceuticals, space exploration, which is a hot field, and printing, 3D printing, there's something there too, I think. Plastics in general. So I wonder if those aspects of the current, let's say, industrial situation might not be a source of increased demand, since the underlying materials are less expensive than they used to.
No, you have absolutely a good point, and I just rushed a little in the presentation, so I apologize not to have pointed that out. But there was a pie chart that was showing incremental gas demand by sector, and I focused on the power sector because I thought that was a sector with the most uncertainty. But you're absolutely right. The industrial sector, first of all, is a big source of demand for gas already and will grow over time. So all the sectors they've listed, I think worldwide, we will see growth. And in fact, the industrial sector is probably a sector where even in a low carbon economy, you will still see and have decent amount of gas in the sector itself. So I agree with your statement, and I do think gas is indeed has and will have still space in the industrial sector.
Other questions? Yeah, please.
Andy Anderson with Energy Watch and recent Columbia Business School graduate. Another question from that same chart with you're showing that 48% of the incremental gas demand was from the power sector. Can you speak a little bit about from where regionally that would be located, and is that mostly new power gen, or is it coal to gas switching, more effective use of the existing fleet?
Yeah.
Just elaborate a little bit.
Well, most of it does come from the non-OECD worlds, because if you do look at Europe, we expect weather adjusted, including Turkey, like 18 BCM, which is actually relatively modest. In Japan, which has been source of one of the biggest source of new gas growth in power due to the shutdown in nuclear, the process is on the verge to revert. Now, the question is just how quickly gas demand will fall in Japan. And then it's everybody's guess on what the nuclear return process will be. But gas demand in Japan, in power, will fall. In Korea, so Korea plus Japan are such a big portion of OECD Asia, Korea demand in power will stay flat in our forecasts, mainly because you have coal and sort of coal capacity is added and sort of nuclear has just come back. So there is not so much demand growth to actually incentivize anything else. So if you put these countries together, the OECD group it, and then US will see and will project the demand of growth in gas, I think around 30 BCM, which is decent growth, considering the resource base and considering everything else. You could argue it's decent, but it's not massive. And so if you sum all this up together, you're not really getting so much new gas demand in power generation from the OECD region overall. If you switch to the non-OECD region, I think most of the growth will come from developing Asia, despite all the challenges illustrated. Because still, it's the rate of electrification which it's really remarkable. I mean, you need 250 plants of a gigawatt size for developing Asia outside China and Japan to reach the US electrification rate of the 1950. So somehow this will need to come. And even if most of it does come from coal and renewable started to pick up, still gas will get that share. So developing Asia, it's probably the region where most of the growth will come from. And then you will have other places such as Africa. I mean, in Africa, you have a lot of structural challenges in getting power capacity built, irrespective of which type of capacity you get built. But most of it in the major consumers, such as Nigeria, Egypt, Algeria, the capacity that is existing is gas-fired capacity. So as long as Africa electrify, then gas will account for a substantial portion of that. The Middle East also will see some capacity coming. Clearly, Saudi Arabia and Iran, which are the two, let's say, big countries which are adding capacity, have gas resources, are trying at the very least, in the case of Saudi Arabia, to free up oil for exports and getting gas. So you will get some of there. So in order, I would say, developing Asia, Middle East, and then a little bit in Africa, a little bit in Latin America.
I'm going to try to get more questions,
Sure,
but if you guys want to jump in on anything, just flag it.
And that's it mirrors energy demand as well, because obviously it's driven by natural gas. If you look at where we see growth, I mean, China and India, as I mentioned, but they tend to be the more risky ones. We've talked about them in detail. But what we call niche markets, so these are the Thailand, Singapore, the Middle Eastern countries such as the Emirates, Jordan, you mentioned, Leslie, Egypt, starting up imports. Those are important source of growth. I mean, you take each separately, doesn't add much, but together they could rival a China or an India as far as an LNG demand center. So it's very important for sellers to keep on following these as well, including Southeast Asia.
Other questions? Over here and then on the front.
Thank you. Timothy Chung with Clearview Energy Partners. So I want to go back to the climate and kind of carbon emissions questions that we talked about a little bit. So conceptually it makes sense. The more you want to reduce carbon emissions, switching from coal to gas makes sense to provide a boost. But how much do you think the LNG sector is considering these commitments? And if they're not considering it enough, could this provide a kind of unexpected boost to demand more so than current expectations? Thank you. And that's for anyone there.
Yeah. So, weigh in on that?
No, I think it's the attractiveness of gas on power generation is the economics of it obviously depends on what gas price you feed into it and the competitive fuel price, coal or petroleum product at particular countries. But the environmental aspect is critical. I mean, at Poten, when we do forecasts for key LNG importing countries, we go from the bottom up, and we do consider the advantages gas brings in an environmental fashion. But of course, you have to look at the competitive price of fuels, whether it's coal and the availability of coal, renewables, and what the government is doing, or the plans for renewables, and all that together gives us a view. So we try to really take into account many of the aspects, but economics tend to eventually drive the decision.
There's a question in the front row. Yeah, microphone's coming.
I'm Alice Balakan, a SIPA graduate, and I would appreciate it very much, this very interesting presentation, because Dr. Kafka and I have been working on LNG in China for more than 2 years now, and it's been on hold. At one point, we were told that China would buy all the LNG it could get at, but it's been on hold for 2 years for various reasons, now being resurrected. I would love your comment on how you think the Asia Infrastructure Investment Bank might add to demand, because they are geared towards infrastructure projects, and there is financing there. I feel that the demand could suddenly change.
You're referring particularly to China? You're referring to Asia in general? Sure. Yeah, I think it's a very, very good question, because in many regions, indeed, the lack of infrastructure is an issue. So, I mean, we did see, for example, Indonesia is another country which, when you talk about infrastructure, really comes to mind in terms of if they were able to really deploy infrastructure more quickly. Even at current gas price, probably you would have a pickup in demand compared to the baseline that we are thinking of. Same story across most of the less developed markets. So my answer would be yes. If you can unlock enough resources to accelerate the infrastructure build-up, everything else equal, this will accelerate the rate of demand growth. However, the fact that you have the infrastructure doesn't mean you're going to get the gas if the gas is too expensive. And I think India is a very good example of it. So India did have, as I illustrated, the gas infrastructure needed to bring the gas into the country, and had the firepower capacity needed to actually burn the gas. The thing is that with the end-user tariffs being set at a very low level, then no utilities wanted or could afford to actually do it. So the infrastructure is an important point, but I think at the same time to be matched with something that, for whatever is a country involved, is deemed as affordable. Otherwise, the infrastructure alone will not really get you the demand itself. But yes, I agree with you, it's one important aspect of the picture.
Yeah. It's interesting because the LNG market has evolved a lot, but the financing of LNG infrastructure has not been reformed. And when you look at liquefaction plants, it's still based, banks want to see a certain portion of the LNG project that has been committed under long-term contracts. For the regasification plants, buyers don't really want to invest in it if they don't think it will be utilized, at more than a certain percent. And it's really hard for governments, to want to invest in projects that just for the optionality of the security of supply it would provide. If you have, banks that are ready to invest in this kind of infrastructure and they don't have the same requirements, I think it would be really helpful to have, in general, a reform of the financing of the LNG infrastructures.
Other questions? There's one in the very back.
Hi, good morning. Jeb Armstrong, Marwood Group. Question for you about, on the supply side, specifically Canada. Very little mention made of that. However, given the proximity of British Columbia to Asia, you'd think there'd be a lot more interest in that. Could you talk a little bit about why Canada seems to have been absent so far from the export game?
It was on my list of questions. We just didn't get to it, so I'm glad we are.
Right. I think in our balances, we don't assume Canada to be exporting LNG by 2020. That said, we also don't expect East Africa to export LNG by 2020, and we do not expect the second generation Australian projects to be by 2020. So it's not necessarily specifically negative on on Canada. It's just that so much is anyway coming, as we have mentioned, that we don't really see so much scope for others. For additional LNG from new countries. Now, I do think, despite the proximity to Asian customers, I do think that the project economics of Canada LNG do look more challenged than the project economics of U.S. Gulf projects, and therefore, Canada need to overcome some of those. Now, is there a possibility that one project or two projects might at one point be online from Canada? Sure. We have recently had the news that the Petronas-led project has taken conditional FID on two conditions which to me look quite possible to be met. So we might indeed get something out of Canada in the end. But I would not really place Canada, despite the proximity to Asian customers, as the best place necessarily to actually sort of fill up that demand supply gap that was materializing in the 20s. But I think my colleagues on LNG might be to add something.
The timing you described is our view as well. We do see a lot of interest from buyers, Asian buyers particularly on Western Canada. So again, driven by demand, so that interest is valuable. The economics is a challenge, we agree, especially at lower oil. So if oil was at 100 and some of these contracts would be long-term oil-linked, some may be hybrid or North American hub-driven partially, but mostly oil-driven. And if you assume that, then the level of oil prices is key here to make the project's economics. So at 60, 65, very difficult. So you see delays in FID. You see a lot of the player going back and trying to improve economics by lowering costs, looking at alternative designs, and that takes time and again delays. But eventually there's potential. There's gas resources. Monetization through LNG would make sense if the right buyer is involved, the right price is offered, and the economics work. It would only add that environmental issues are a big issue in Western Canada, and also First Nation issues for both the pipeline right away and construction and also the liquefaction facilities themselves, which has contributed to the delays.
I know I could take all the questions both in the room and online on Twitter, but I think we have room for question, maybe one, maybe two more, but yeah, over here.
Hi, good morning. This is Robert Murillo, MUFG and former SEPA alum. I'd just like to get your view a little bit on the U.S. market. You've given a very comprehensive overview of the world. Just wondering, we see the U.S. with Henry Hub prices below $3 during this year. Generally, it seems expected that exports to Mexico, LNG exports, further demand from the power sector may support higher Henry Hub prices going forward. What's your view on that?
Yeah, we don't try to really capture the year sort of year variation in demand, and the year variation in price, that we take more of a 5-year outlook. So we also don't really forecast prices per se. So the way we are thinking about the US market is that we are still in that sort of price range, let's say 250 to 4, which at 4 you will allow more sort of drilling and more production. At 250, as sort of we have been in Q1, you will sort of rebalance sort of an oversupply market via switching away from coal into gas, as we have seen in the data of Q1, which showed gas power generation up 20%. So we are not really projecting throughout the forecast period any substantial breakout from this sort of dynamics. But again, then of course, if you are working gas trading, it's such a general answer that I'm giving you. And I being, in banking, doing commodity research for trading, so I do understand the differences. But I mean, the general line is that we expect by 2020 to be in this sort of dynamic.
So the general view of the EIA and many others as well, that the U.S. has a lot of gas supply in the $3 to $4 range. You agree with?
Yes, exactly.
So we are at 11 o'clock, so we're going to stop there. But this has been a really fascinating overview of the global gas market, a great tour around the world. And given how many moving pieces and how many things are changing, I'm really glad we were able to come together and do it. I appreciate your traveling to New York to present the medium-term report to us, and Leslie and Majed for your taking the time to share your thoughts and insights and expertise as well. Please join me in thanking our panel.